Fence Marketing Profit Podcast. Interviews with million-dollar-plus fence and gate business owners on how they market and grow their companies in today's economy. Hear directly from the most successful leaders in your business and discover what they're doing to keep their phones ringing, trucks running, and businesses booming. With your host, Scott Andreessen.
Well, hello, everyone. This is Scott Andreessen with Fence Marketing Team, and we have a very special, awesome webinar today on budgeting for your fence company and how to set up your budget to maximize it for profit. So how to forecast your fence company's budget for maximum profit. And we have with us Mr. Shawn King of Mr. Fence. How are you, Shawn?
Fantastic. A little nervous. Hope I can deliver this information. We'll see.
You showed me a sneak peek of this, and I was absolutely floored. I mean, this is in depth. This is awesome, and anyone who has any questions at all about how to budget for their fence company, I know this is going to be a tremendous help. So, without any further ado, let's go ahead and get into it.
Fantastic. All
right. So I'm going to just start off doing a little screen share here. Okay. So how to forecast your fence company's budget for maximum profit. This is very timely because a lot of business owners right now are doing just this. So,
or should be.
Yeah, absolutely. And Shawn, I just want to take a brief moment to show everybody this photo. I love this photo of your team here.
Yes, we have a fantastic team. I'd say we're about maybe a medium-sized company, right? We're not one of the big boys by any means, but we have enough experience under our belt that we've been in this business 25, 30 years approximately now.
Awesome. Very cool. Now, on today's agenda, what we're going to be covering, we're going to be forecasting your budget, how to build a predictable fence company down to the dollar a day. Shawn is going to show us exactly how to do that.
As close as possible, yes.
What to charge, that is the age-old question everyone in fencing asks. And you're going to help them answer that, right, Shawn?
I am absolutely going to give you some valuable information to answer that question. The reality of it is your business structure is going to teach you or tell you what to charge, and we'll go over that more in depth. I know that on our Fence Professional page, we often get people requesting, hey, what's the going rate for this and what's the going rate for that? And we have to constantly tell them that, how illegal that is to be sharing pricing across that social media. But we can share and teach and learn from each other on how to appropriately price based on our company structure. We can do that.
And we're going to cover the 4 buckets they need. There's a little error in the acronym. It's actually POLM. We're not going to share with them just yet what that is, but that is a hint. And it's pretty critical to maximizing their profits, right?
Yeah, my bucket or my 4 buckets analogy, I think, simplifies this as much as I possibly can able to simplify thinking about your company and all the income and all the expenses that go with it.
Now, in our brief talk last week, you shared with me some tips on leasing versus purchasing, and I think a lot of people don't realize this kind of stuff. So that's going to be helpful. Some pro tips on when to purchase or lease certain items to maximize profits and save your cash flow.
True. And it took me a long time to figure out the difference between the two of these. And used properly, they're both very beneficial in your business. Oftentimes, I think it's ego. It gets in the way. Sometimes people want to be proud of the fact that everything's paid for, and they crush cash flow and can inhibit growth by buying too much assets at one time rather than let that asset earn its keep. We'll talk about that a little bit more.
And then a really granular view of your budgeting strategy. The spreadsheet and everything, you're going to share with us exactly how you do it.
I am going to share with you guys my spreadsheet that I've spent the last 10 years developing. Every year it changes a little bit more, becomes a little bit more in depth, a little bit more accurate with historical data. This sheet is really only a value of the information you put into it. So the value of this sheet that I'm going to share with you, its value is reflective of the amount of data you're able to put into the sheet. So historical data is very important. Some of you may not have this historical data, and we walk away from this meeting, at least you should be thinking to yourself, wow, I should start tracking all of those categories so that eventually I can start having a very accurate forecasting and budget conversation.
Super. And then at the end, are you okay with a little Q&A session?
I'm fine. Let's go for it, right? So before we get started too much further into this, I want to preface all this with, I'm a fence builder. I'm not a CPA. I've never even taken an accounting class. So everything I'm going to share with you, you got to bear in mind that I'm not a professional in this. I'm not a CPA. I can't give you professional advice. I'm an attorney, and I work with the IRS. So everything I give you, take it with a grain of salt. Talk to your own CPAs, make your own decisions. This is historically what has worked for me. I do have had and do currently have a CPA that works for me, a firm that we hire that has been watching everything I've been doing for years. So I can tell you that my methods have been looked at by my CPA, and they're blown away by the in-depth that we have with our budgets and forecasting and P&Ls. We do use QuickBooks in our company, and that's very crucial because it allows us to track almost anything we would like to track with our business. So those of you that aren't using some sort of software, you're probably going to need to look at starting with something to help track all your income and expenses.
Very cool. Okay. So, folks, this is your time. So I want to do a quick bit of housekeeping here that silence your cell phones unless, of course, you're tuning in on a cell phone, which I see some of you are, so that's awesome. But close your doors and then lock your door, right? Because people are barging in. This is your time. And I know it's funny, but, you know, it's not often that for some of us, to have this time to work on our business.
This is very accurate. So I said that the other day to somebody, I even posted on Facebook, we need to work on our business and not in our business as much as possible. A lot of times as owners, we get drugged down day-to-day activities. We're worried about the next sale. We're worried about the next material. We're worried about getting the next job installed. And we lose focus of working on our company. And what we're going to talk about today is working on our company. I dedicated a few days to our budget this year of just working on the budget and analyzing every line item and where we're going to go next year. I dedicated that time. I pulled myself out of any day-to-day activities to make sure that I can dedicate my time to this. So I just locked my door. So I should not be interrupted during this time for you guys as well. I've been asked, a couple of people asked me, why am I doing this? The reality of it is, why did we create the Facebook page? Why are we involved in sharing information? Why are we part of the AFA and help with the fence instruction? The brutal truth is, I've been blessed. This industry has blessed me and my family with a wonderful income and a wonderful means of living. I'm very proud of this industry. And it takes, as an industry as a whole, to give back to each other, quit looking at each other as the enemy or the competitor. We're one big family fighting the same battle every day. So I'm sharing this information, private information, across the board to everyone out there that's willing to indulge with their time and listen to me. So it's to help the industry. I'm doing this to help the industry. There's no other reason than that. I love talking to people and finding out that I helped them along the way in some small fashion, because I can tell you there's a ton of people that have helped me to get to where I am. I didn't just wake up one day with 30 years of fence experience and figure out this budget. This came from years of classes of going through with the AFA. I used to go every single fence tech. I went to as many as I could, and I attended all the classes I possibly could. I've attended seminars and webinars that I possibly can to learn this information. Those are people giving me information and giving me their time. So this is me giving back. Hopefully it's of value to everyone here, but that's the reason.
For sure. All right. So folks, without any further ado, if you're a fence or gate business owner and you're serious about better results in your finances for 2020, the next 60 to 90 minutes will change your life.
I don't know about change your life, but we'll definitely get you thinking, right? We're going to have a conversation about things that you're probably going to walk away from here going, and at least be thinking about. So I'm going to share with you guys right off the gate my budget, and it's an Excel sheet, and it's thorough, and so if you're watching on a cell phone, it's probably going to be difficult for you to follow along because it's a big sheet. And what I'm going to do is go over the sheet real quick. There's a glance. But don't panic because I'm going to go back through from the top down and try to explain how all the pieces work. But to understand where we're going, I'm going to show you the whole sheet at first at a glance to give you some idea where we're going, and then we're going to go back through it and talk about what the importance of the different items. Make sense?
Super. So
Okay.
Shawn, we'll get to that in just a moment. I wanted to share with people how they can do a chat at the end.
Oh, yeah.
So folks, at the end or right now, we'll get to, you can start adding your questions, and then we'll get to them at the end. And how you do that is you're going to see a little chat button. You might need to click more, and then you'll see chat, and you can start adding in questions, and then we'll get to them at the end. And it's right there. And so we've got a lot of folks here, Shawn. We've got Blake, Chris, Damian, David, folks by phone, Josh, Joshua Glover, Jair Riggins, Larry Martin. What's up, guys? Mark, Mike, Ryan Gates, Ryan Lehman, Shauna, some more people by phone. So quite a lot of people attended this. That's awesome. Folks, I want to know how many of you right now are tracking your budget for your business. Just type in the chat box, Y for yes, that you're doing it. Let's just see how many people are doing that.
I hope everybody. There you go.
Lots
Josh, you may have to help me. Josh, I know you're tracking using the same sheet we are. He may have to help me through this process. If I miss something, Josh, pipe in there.
Josh typed in LOL. Yeah, Ryan Lehman, 100%. Super. Okay, so that's good. A lot of people are, so wonderful. And if you're not, hey, this is your opportunity to get yourself in check and do it right.
Yep.
So question number 2 for you folks is, what is in these 4 buckets?
We're going to call those income buckets. Let's think about them like income buckets, right? Scott?
That sounds good. And let's see if any of them know right off the bat. POLM. Does anyone have an idea of what that is? Josh typed in profit. Yep. Now O, L, and M. What are those? Hey, wait, Josh. Josh is kind of cheating though, right? He has your sheet.
Yeah, Josh has my sheet. I like it. I like it. I see a lot of good answers down there. Labor, materials, overhead, profit. You guys are hitting the nail on the head, right? So every dollar that comes in the company, every dollar that comes in, we got to think about that dollar and rip it up and tear that dollar up and put it into a bucket, a piece of the dollar into each bucket. We're going to plan with the end in mind. So we're going to start with profit. We're all in business to make money. Let's be honest with each other. Nobody's doing this for a charity event. We are all in business to make money, and we should be proud of that. Will you go back to that previous screen real quick?
I will.
So we're in business to make money. So profit is what we want to start with. We want to look at how much profit do we want to make and be thinking about that in a percentage. Be thinking about it in a percentage number, right? Our overhead is something that we get to work on when we talk about budget. We get to create our company structure, our expenses, and that's going to be overhead. So overhead is everything that is non-related to a direct cost of building Mrs. Smith's fence. So it would be keeping the lights on, the insurance, the fuel in the trucks. It would be the computers and software you're using, office staff, non-direct labor. That's going to be overhead. Those are things that we can influence and change by buying or creating a more efficient office or using better software. But we can't on the fly immediately impact those. Generally, there has to be some planning involved. So overhead, I call it the bill in the night. That's something you have to pay no matter how much fence you build. Labor, when I talk about labor, I'm referring to direct labor. So that's labor on the job site or working directly for a project. It might be fabrication. It might be loading and unloading a truck, but it's labor that can be costed to the fence installation of Mrs. Smith's fence. Materials, that is just the materials associated to the installation of the fence, right? So not non-direct type materials, which would be shop supplies or job supplies, but your direct cost of materials. So these are the 4 buckets that we can think about today. This is how I do it. This is by no means the only way or the best way, but I like to generalize everything into 4 buckets: profit, overhead, labor, and materials. Labor and materials together equal cost of goods, and we're going to talk about that a little later, why that's important. And we're going to talk about percentages. We want to equate percentages to each one of these. That's going to help us budget and forecast. It's going to help us charge accordingly. Like the question earlier, what do I charge? Everyone asked that question. Well, we're going to get to be able to show you how to use a baseline check based off of your budgeting, your overhead, by using a percentage. So the percentages are very important. So overhead is going to be non-direct costs. Labor and materials are going to be cost of goods, direct costs, and profit. When we talk about profit, I want to clarify that. There's a big discrepancy in the industry when we talk about profit and percentages. I've noticed by speaking to fence companies, profit, when I talk about profit, I'm talking about net profit. That's after all expenses, not gross profit. Gross profit is totally different than net profit. Gross profit is what's left over out of cost of goods. Cost of goods is labor and material. What's left over is gross profit. Out of gross profit comes your overhead and net profit. So when I have these 4 categories, I'm referring to net profit. Now that's before depreciation and taxes, okay? But net profit after overhead. That's how I'm going to refer to that today. So keep that in mind when you see the percentages of profit. I'm not talking about gross profit, which we will talk about that as well. Make sense? Okay.
Very cool. Now, Shawn, I do want to point out to folks tuning in on Facebook that there is a 6-second delay. So just keep that in mind for the Q&A session at the end. And then, Shawn, I'm going to turn this over to you here in just a moment. I do want to give some shout outs to Rachel, Ryan, Mike, Clark, Luke
Gibson.
Thanks for joining us, guys. So let me go ahead and have you drill down, Shawn. I'm going to stop sharing my screen and let you present there.
So give me some feedback, Scott, on whether I should zoom in or not. How does that look? Can you read the data?
Yeah, I mean, on my computer, it shows up very well. You may want to do that annotation thing where we can see where you're actually clicking. So if you go to view options up top. Oh, you got it. Super.
Yep. Okay.
Super duper. Now we can follow your mouse. Excellent.
So they can kind of see my mouse here and hear my voice. So this is the top left corner of this sheet. As we go through this, you're going to see this sheet is, go ahead and panic now. Get that out of the system. Because as you see, we're going to go through all this data and there's a lot here. This sheet is going to be similar to your profit and loss statement out of your QuickBooks or profit and loss statement, however you equate that. So I have designed this sheet to match my P&L statement very, very closely. And that allows me to input data easy, copy and paste. A lot of times I can take data out of QuickBooks, put it into an Excel sheet and paste it in here. So I don't have to enter every single one of these cells. A lot of these cells, guys, you're looking at are computed back and forth with one another. So there's a lot of formulas in here. I'm not filling out every one of these cells throughout the process. But to give you an idea, across the top, I'm going to go ahead and scroll over here and show you that I have those 4 categories: overhead, labor, materials, net profit, and gross revenue. So your 4 buckets have to equal 100%. Have to. So if I change my overhead percentage, it's got to change somewhere else to equal 100%. I can't be over or under 100%. You'll notice that this sheet I've broke down to 2 different categories of expense and income. I have income and expense related to installation, which is what we primarily do in our business. So related to installation of fence. And then I have a category related to retail. Some of you guys may be more retail or less or no retail. Some of you may want to split this up between residential installation and commercial installation. The reason why that's important is that for instance, in a retail world, I don't have labor associated with retail. I sell something over the counter, there's no labor. If I delete the labor percentage out of the equation, then I don't equal 100% anymore. So the percentages per category are going to have to change. If you notice my cursor, materials cost is 50% on a retail order. That's what I'm budgeting for. And over here on installation, it's at 40%. But bear in mind, the material is the same material from the same supplier and costs the same exact amount. Relative to the gross revenue I'm charging for the job, it's a different percentage. So it's a different percentage. So my labor is taken out of the equation, so therefore my materials become a bigger piece of the pie, of the total pie. So I've created these. Right here where I have my cursor in cell number R, I've got a 5% overhead cost to these, associated to these numbers. And over here I have a 95% of cost. What that means is that I'm suggesting that installation side of my business is going to carry 95% of the overhead load of my company. And retail sales is going to carry 5% of the load of my company. Now that's relative down here. First line item, 5% of my revenue is budgeted to come from retail sales. Historically, 2017, 18, 19, and now budgeting 2020, these are my retail sales. Historically, I have data that tells me that 5% of my business is generally right around retail sales. So that means that my overhead in line, I'm going to equate 5% of the cost to it. Makes sense. It's in line. I wouldn't want 50% of my overhead costs associated to retail sales because it's going to skew these numbers and they're going to make them invaluable to me, right? So I have two buckets here. Let's use a different word. I don't want to use buckets. I have two scenarios here of overhead, labor, materials, net profit. And in retail, I have overhead, materials, net profit. Now, why that's important is as I scroll over, your P&L, your end numbers are going to include both those scenarios. So that they've changed. If you notice over here, my final numbers, so my goal for the year is $3,030,318. That's the budget for the year. That's total gross revenue that I'm trying to achieve. And we're going to break that down here shortly and where that comes from. But my total overhead is going to be $1,030,000, and that comes from the sheet below. I didn't get to type that in. That's a number known from known cost. I'm at 34% overhead. That's a formula that comes from another sheet, a part of the sheet. But I want to pay attention to something. 12.35% is what my labor is as a whole to all the revenue. If I scroll back, I want you to look at something and pay attention. Labor over here is 13%. 13% is budgeted for installation sales. But when I skew my numbers and put retail sales into the same revenue, which is what we do in the last cell, the percentages have to change because the revenue is changing. I'm adding more revenue to the bottom line, but I'm not adding any labor costs. So my year-end P&L numbers are going to be a little bit different than what I budget for installation sales. Why that's important is when we go to sell a project and we're talking about an installation project, we want to make sure that we're using accurate installation numbers and not our skewed numbers on the P&L at the end of the sheet. It may not be a big deal for me because only 5% of my revenue is retail sales. But for those of you that might have a 15 or 20% retail sales, that number could really be skewed. And you use the wrong number, you're going to be selling for the wrong price, chasing your tail, wondering why at the end of the year, you've either lost money or made way more money than you wanted to make. I don't know. Or didn't hit your gross revenue because your prices were too high, right? They all have a give and a take, a reaction to every action you make in your business. So those are the scenarios. The other thing that we track is the number of working days generally in a month. So we are equating at 22 working days, production days in the month of January. And these are historical averages that we have tracked, 19, 21, 22. Those are important to have accurate data in there because as we get down the sheet, I'm gonna be able to tell you that per day, what revenue you need to be generating to overcome your per day overhead expenses. So that way you understand when you're losing money and making money almost down to the day. So that's information that you can draw up through Excel sheets. We use it through a calendar. So I'm able to check, 2019, we worked 22 days. In 2018, we worked 21 days, and I get an average. That it also includes like holidays and rain days. So non-production days are in that. So historically, we've gotten 22 working days in the month of January. Right above it is two percentages. So there's a 10-year running percentage and there's a last year running percentage. What those percentages are is the percentage of gross revenue that we completed in the month of January last year compared to the total income for the year. And then the 10-year average is the last 10 years, on average, the month of January has equaled 5.5% of our revenue. These numbers are very important because these numbers are what's used to in the equation to get your cost per month associated down on the bottom of the list. If we know that our income or our cost of goods is X in the month of January, we can use it, multiply it by that, or we know what our total income is, our total cost is for the year. We can multiply it by that percentage and get a total cost equal to the value of income we're doing that month. So the last year is the most important one. I use last year's percentage because that's a better reflection of where my company is today, right now. The health, the type of company I'm running, that's a better indication. But I like seeing the last 10 years because it gives me an idea where I came from, gives me an idea where I'm going, right? I had a couple of anomalies in the past 2 or 3 years in the beginning of the year that are skewed those numbers up. That's why they're so much higher in January and February. Last year it was going to Florida and doing work down there for the hurricane, which really bumped up those numbers. So the percentages, the number of days, the scenarios at the top of the sheet are very important. Now, your business structure, where is the money coming from? So this sheet, part of the sheet you see on your screen right now, this is all income, total income, 100%. Again, we got to make sure that we equal 100% through our categories. So for us, we sell vinyl fence, aluminum fence, wood fence, chain link fence, colored chain link, steel fence. We also do decks, wooden composite, docks, pergolas, railing, gate operators, land clearing, staining, power washing, snow removal. So through this process, we're using averages. So I know historically where my average is total revenue of vinyl fence sales compared to my total revenue total for the year. So last year it was 34%. I've had some conversations, understanding where we're trying to go this year. We're making some small improvements to try to get that to 36%. We are, as a company, our bread and butter is aluminum and vinyl fence installation. That's where we make the best margins and have the least complications and problems. We are best suited and tooled for that type of fence. So I'm going to try to drive to 36%. Now these are numbers I get to put in here. So when you're creating your budget, I get to manually enter 36. I could put in here, I could put 35 and say, you know what, I just want to grow by 1% there, 35, the whole sheet updated, but down here I'm still at 99%. So I know that if I decrease my vinyl sales by 1%, something else has got to increase to equal 100% of my business. So I'm going to say I want to do a little bit more aluminum fence. I bumped that to 15. Now I'm at 100%. But my total revenue goal for the year, vinyl fence, is 35%. I'm at $1,060,000 right there. And aluminum fence is at $450,000. That's total income. That's the sale of the contract to the homeowner. Gross revenue is what we're talking about. The sheet double checks itself right down here. It says $3,030,000, which is the same number that was over here in the top part of the column. The total revenue for our company is budgeted at $3,030,000. What that means is if we hit that total revenue and we keep our overhead where it is budgeted for, we didn't make any major purchases or costs hit us, and our labor stays in line, then we're going to end up making the 13.15% net profit, right? Depreciation and taxes still going to come out of that. The way I have this sheet built is owner's income. My income is in as an expense. So I've already paid the owner's income in this sheet. It's in overhead. I have my owner's income there. So back over here, I've got these income streams. Here's my totals for 2020. I can utilize 2019, 18, and 17 as a quick glance and make sure that I'm tracking. Does it make sense? You can see right here, I've budgeted to do less wood this year than last year. I want to do more vinyl and aluminum and less wood. So you can see I've dropped it to 424. That's higher than we did in 18 and 17, but a lot lower than we did in 19. Does it make sense?
How can I interject one? Yep. How are you arriving at the 13% net profit? Is that something that you chose, that's what I want, or it just Yeah.
Yeah. So we'll go back to this right here. We're at the first piece. We start with the end in mind. So I start with, I get to enter in that equation 13%. So I had to make sure that all these add up to 100%, right? And so I know that my labor and materials have historically costed me about these percentages on average. When I go back and look at my numbers. And then overhead was, the year before was at 36%. So I'm trying to get my overhead cost to 34% of the bucket. Now, I'm also trying to lower my overhead cost, and you'll see down below, every category has been dissected every which way possible to try to get that accurate information of where my cost is going to be and where I can save money. But I want it to be 34% of the total revenue generated. And so what happens is I end up with 13% left over to get to 100%. If I change this to 36 like it was last year, then I got to change this one to 11. And now I'm at 11% net. And again, remembering the numbers get skewed when you throw in retail, I come over here, it's 11.26% is what's actually budgeted because of the revenue generated from retail sales. Does that make sense?
Yeah, makes good sense. Very cool.
Again, this sheet is something I've been using for 10 years, so it's easy for me to navigate. I can only imagine what some people are thinking right now when they're looking at this thing. It might be overwhelming. I get it, but you gotta start somewhere. You guys may not have all these categories. Just start by breaking it down to a couple of categories to start with. I've never talked to anybody yet that has broke it down as much as I have here. The one thing I asked me the other day, someone asked me, who do you share this information with? I think was a question. And last week I shared it with the shop foreman, the salesman. I shared it with the office girls up front, obviously accounts receivables, accounts payables, even our scheduler up front. She got to sit in the meeting. The reason for that is I need them to understand the totality of the company and where the costs are associated and why we're paying attention to different categories. They need to know. They need to know why it's important that every time they enter a job that we get it entered into the right income bucket. Why is that important? The other thing that came up was very interesting was, as a whole, they said we need Shawn King to do more decks, docks, pergola estimates for next year so we can sell more decks, docks, pergola estimates. We don't have anybody in-house that feels comfortable doing the decks and docks and pergolas. And what we figured out was if I spend my time doing that, then I'm working in the business, I'm not on it, I get distracted, and I'm not watching the overall picture of the business. And then we start to lose big other places. Well, the reality of it is, guys, if you look at this sheet, by having this sheet, I'm only equating all that work is only about 9 to 10% of our total revenue. 9 to 10% of our total revenue is coming from decks, docks, pergolas, railings, and land clearing and all that stuff. But the reality of it is the girls tell me it takes them 20 to 30% of their time to schedule it, communicate back and forth to the homeowners. Then Shawn spends 30 to 40% of his time working on those leads. So you start asking yourself the question, is it really worth it? Is that 9 to 10% really worth the return on investment? If we didn't do any of that and took all that money out and focused more on increasing vinyl aluminum sales that we're really good at, grow the business in that realm and close this part of the business down, what could happen? Like, can we make up this loss of income of a couple $100,000? I think we could rapidly. And then when we make it up, we have less risk. We're better at vinyl aluminum fence. And who knows where we can grow from there. So the conversation was maybe 2020, we cut all this stuff out. It's scary because right now we're fighting for every dollar we can get in the wintertime to keep cash flow up. Like I literally ran 2 deck estimates last week. And I thought to myself, I need to stop doing this at some point, bite the bullet, say that's it. We're not a deck company. We're not a dock company. We took these jobs because we thought we had to have the cash flow in the door every day. It's a big step, but it's something that at least this sheet can tell me. I didn't know that we were only at 9 to 10% for all that. At least this sheet tells me that, and I can make that decision based on, do we want to pull it out and try and see what happens when we redirect our manpower and our efforts into vinyl aluminum fence cell and be specific about our time. So that's the income piece. I'm gonna move down the sheet. So the income piece is up top. As we go to the next part, the cost of goods. So material, direct labor, job supplies. these are categories a lot of people don't think about. Job supplies equates to, on average, 2 to 3% of our jobs. That's screws and nails and glue and the insignificant pieces you buy in bulk that get separated to all the different jobs. We actually pulled that out. It used to be in overhead expense, and that's, I don't think is accurate as putting it in the cost of goods, but it's difficult to put in cost of goods because we're not counting nails. And we're not counting screws per job. So we have associated a percentage to it. These are the total costs. So this year I'm budgeting $86,000 to job supplies. Last year I spent $89,000. Year before that was $113,000. So I know that my percentage is in line, 2.85% of the installation sales. I'm sorry, 3% of the installation sales, 2.85% of the gross revenue total as a company. Again, skewed numbers because 86,000 of the total revenue is a different percentage than 86,000 of just installation sales. So you've got to be thinking about skewed numbers. My materials cost is up the top here. That's total materials costs across the board for every type of project we build, which gives me a cost per job, right? Or a cost percentage for just materials reflected against gross revenue. Things we don't want to forget about, wasted materials, we got to account for that, damaged utilities, and then non-direct labor. So that's guys clocking in that don't associate the time to a job but are not part of overhead costs. And that happens. Sometimes they're loading a truck and forgot to clock in, or working on a truck and didn't clock into a job, working or cleaning the yard. But I want to pay your attention to right here. These are very, very super important numbers. This is, you said, what should I charge my business? Well, this is right here is going to tell you. Cost of goods, according to this sheet, is at 52.85%. My gross profit is at 47.15. You hear people talk about, oh, my profit's 35% or 40% or 50%. They're talking about gross profit before overhead. I don't know of a single fence company that's making a net profit of 47%. And if there is one, please, by all means, start a webinar and teach us all how to do that. Because it's just, I can't imagine how that's practical. 47% gross profit. Very important numbers. I'll show on the board here how we take those numbers and use them as a baseline check against, let's say, what you think the going rate of an installation per foot for a fence is, or your fence software tells you that you should be charging this per section or per foot, or someone has told you that, hey, I can get this done for X dollars. You can use these percentages, work backwards, and tell you that your business should be charging Y for that job. And we'll come back to that. But those are very, very important numbers. So if you see the 52.85%, right up here, I got gross profit and cost divided by 0.53. So I've rounded the 52.85 to 0.53. And we're going to use that number to get a installation cost for a homeowner. Hopefully,
Shawn, I just want to interject. We have questions coming in, and guys, we'll get to those soon. And then David Ball says, Shawn, great info, using almost the same forms and formulas. Good job with training. Have a great year.
Fantastic. Thank you.
So,
I guess, do we have any questions that we need to take right now over that piece before I go down further?
Well, so we have a couple here. Ryan Gates is asking, how can we get access to the sheet to use in our companies? I think you'll maybe cover that a little later. Right. And then someone anonymous who wishes to remain anonymous. Okay. I like the idea you brought up of working on your business rather than in it. When you find yourself working in it, what do you do to shift focus back to working on it? You have to make it a priority. Like, it's tough. Sometimes you gotta let things go. As what I've found in the defense industry is that we are we're probably one of the most prideful industries, at least that I've ever seen, that I know of, that I've been part of. And I work in a couple other industries as well, right? So I've been for law enforcement and some distribution business and things, and very, very prideful. And so when we as owners or high-level managers see people below us performing at a level that is a little bit lower than what we can do, we like to jump in there and just do it ourselves, or tell them they're not doing it right. We need to spend time teaching them. That's working on your business, rather than doing it for them. That's working in your business, right? So it's a conscious effort
to fix that problem. I fight it every day. There's a lot of times, just like me running these doc and estimates, I should probably find somebody to do those. But I find it easier just to go do it myself because I know it's accurate. It's not the right way to do it. But I've done a better job of allowing my guys to build fence. I've given them the tools, I've given them the knowledge, I've given them the resources, I've given them the right material, and I let them go build fence. Do I show up on a job site and see a post that I could have set better or a gate I could have hung better or maybe the dirt work's not as good? Absolutely. Do I nitpick that? I try not to. Is it tough? Yeah. It's very tough to show up there and see something and say, I could have done it better. But as a whole, the synergy is you'll never do it better every time than the whole team can do it as a whole, ever. And you'll end up being an owner-operator fence business, building fence as one or two crews. This will end up happening. So if that's what you want to do, then that's fantastic. If you want to grow a business with multiple employees and crews in different locations, you're going to have to get out of your business. Hopefully that makes sense. That's what I mean by that.
Awesome. Now we have another question, if we could, from Josh Glover. And by the way, Ryan Gates says, thanks for the answer. Josh Glover asks, what did you do to decrease overhead by 2%? i.e., for example, was it maintenance, more efficient systems, et cetera, have an effect?
Yep. So the next piece I'm going to get into is that overhead piece. But to make sure I'm clear, there's a difference between lowering the percentage and lowering the dollar amount. So lowering the dollar amount, we're going to talk about each category and where I thought we could save money and where we're going to spend more money. That's important. Don't just go through the budget and cut money everywhere and ignore the fact that you may be adding a truck or adding a salesman or adding a new service or adding new software. Like, you got to account for that. It might be ugly and it may be something you don't want to talk about, but if you're going to be buying a new software system that's going to cost you $800 a month, you better plan for it. If you think you're going to be buying another sales vehicle, leased or purchased, you need to be planning for that. Or you think you're going to bring on another salesman and hit that revenue, you need to be putting that in the budget. You're going to lead yourself down a very dark path if you end up just cutting numbers and being naive with yourself saying, oh, I can make that work. Be real about this sheet, okay? Real information in, so I'll give you real information out. Garbage in, they'll give you garbage out. This is only as accurate as you're going to put accurate information in there. So be brutally honest. So we're going to talk about how I did save money on my overhead, but the percentage, you saw I changed it from 36 to 34%. I get to pick that I want my direct overhead, my cost of overhead, my overhead cost, I get to pick. Do I want it to be 34% of my total revenue? Do I want it to be 35% of my total revenue? Like, I pick that number. Do I want my overhead cost to be 20? I can put 20 in there. And if I put 20 in there, I've got to figure out where the other 14% went. I got to take it out of overhead, take it out of materials, take it out of net profit. Maybe don't have any profit. I can make it 20%. So you can make the percentage whatever you want. I know that I have historically had it between 34 and 36% on average, year after year after year. But I can change that to any percentage I want. Hopefully that answers the question. Now, down below here, everything's in pink and green. We're going to look at expenses. We're going to look at known expenses, what was previous year and the year before and the year before that, as compared to what we're going to be doing this year. So this is where you take every line item, you're going to be thinking about it. Are you making a change in that item? This might take some time to go through. I'll go through some highlights. You guys have probably seen those two big chrome monster trucks that we put out in the field last year, the big flatbeds. So one of them I did earlier in the year, and I had a lease payment on that truck. So it's $1,592, and there's that. Last year I spent $6,000 in lease payments on that truck. This year I'm gonna have it all 12 months. So all 12 months are in here. These categories are by month. These columns are by month, and it gives me a total here, $19,000. So that truck is gonna cost me $19,000 a lease, and I don't get to change that. That's gonna stay minus getting rid of the truck. The second one we did is right down here as well. Sorry, that was the second one. This is the first one we did. And that lease payment per month, I don't get to fix that. There's another, my big black truck is in here. There's the lease payment. The Fort truck's in there. Now we got rid of some of these other trucks in here, so I don't have those payments this year, right? So known cost and lease payments. I do lease some vehicles on purpose so that I can expense them. And I buy some vehicles on purpose so that I can depreciate them. But by expensing these, that comes right off of the bottom dollar at the end, right? So if I were to buy these vehicles, they're going to be an asset, depreciated. They're going to go to the bottom line. They're going to be on the net profit. and I got to find ways to get them off. Sometimes you end up purchasing something up front, pay for the whole thing, the $100,000 for it, and you take that money out of cash flow and you put it on your balance sheet. And by putting it on your balance sheet, then you start to depreciate it. Sometimes the depreciation is not equal to the value of that impact to the cash flow. So that's something you got to talk to your accountant about. I do a little bit of both. I expense to keep the profit down on some of them. And then I buy, if it's 0% interest, I almost always will buy that as an asset and pay payments on it. I won't buy anything, spend all the cash up front. Like I've never bought a $50,000 truck and paid cash for it. I believe in it, earning its keep as it goes along. So these lease payments, these things are earning their keep. And by buying something on 0%, it earns its keep. I like to suggest that I run my business in cycles. So not every year am I trying to make as much net profit as possible. I know it sounds weird, but not every year. You got to balance between making the banks happy and then not paying all your money to IRS. So depending on how you keep your record keeping, if you show a huge profit, you're going to pay more in taxes. If I show less profit by expensing things I can expense, then the banks generally aren't as happy. So getting money to grow, getting loans is more difficult because they want to see profit. I've learned this the hard way, and I do it in cycles. So I literally will make the bank happy. Okay, make Shawn King happy, less profit, less to IRS, make the bank happy, pay IRS, and I run through cycles. It's not really every year. Sometimes it's every other year. The other part of the argument is you don't want to grow, because you end up crashing. You want to grow and then recoup, become lean and mean, get used to that new growth, and then grow again. That's dangerous if you try to grow every year over year. Growth, it's hard to make a net profit in growth years. It's also hard to sustain growth. Things start getting real hairy and shaking and falling apart, and you run into some high risk. And I think that's happened to them. I've witnessed it. So be smart about your growth. It's not always about growing every year. So in particular, guys, this year is less overhead than last year. Less gross revenue than last year. My budget is for $3 million. We did 3.3 last year. So I'm lowering my gross revenue by 10% this year, but I'm increasing my net profit by 100%, right? So last year was a growth year. This year I'm focused on net profit. I'll make banks happy. I'm going to pay more in taxes. I'm not going to be able to expense as much. I'm focused on getting lean and mean and cutting this budget. Hopefully that makes sense. It's not always about bottom dollar, getting as high as possible. We got to pay attention to making money. I'm being smart about it. The economy has been great the past 2 years. Great time to grow. We got to be careful where the economy is going. It's for me. I think it's safe to try to regroup, build up our assets a little bit at this point, and get our company strong, and then look at whether we want to grow again another year or two. So
we have real quick. Another question came in from Josh. If you were to visit a fence company, any fence company, is it obvious if they budget correctly for overhead? Based on the company's, is it obvious if they budget correctly for overhead based on the company's appearance?
I think the question is, when you show up there, are they working out of a visible, attractive, clean, neat company that's not of a pickup truck, right? Somebody that's got overhead. So is there a building? Is there a front storefront? Are the trucks clean and neat? I think that's what Josh is getting at. And I believe you can tell if someone doesn't budget for that, they're not going to be in business, right? And if they are in business with that image, they're obviously budgeting for overhead. Overhead's probably not as important in a guy that's working in an owner-operator business. A guy in a pickup truck with a couple of buddies helping him build a fence, overhead's probably not going to make as big of an impact in his business. His overhead might actually be 10%. And those type of businesses might be making a 25% net profit because they don't have all that overhead expense. But what you find is they'll do less revenue generally than a company that's highly visible out in the forefront, right? So their revenue will be less. So they might make 20% net profit on 100,000, 20,000 bucks, whereas a much bigger company might make 10% net profit on 2 million, it's 200,000. So a big difference there, right? Big difference on the bucket. I want to call attention right here, guys. Advertising, I made a conscious effort in advertisement this year. So last year I spent $65,000 in advertisement. So that is going to be SEO work. It's going to be Facebook, Google, ads that we might run, sponsorships we might do. All that goes in that bucket. So, and then offset it with co-op money that we might receive from a supplier. I'm lowering that this year, pretty good chunk. But we went through every category and decided where we were going to make cuts, if we were going to make any cuts, and we were going to add. And 50,000 was what we settled on. There's a lot of time that went into this. So what you don't see in that $65,000 spent last year, you don't see the pages of data that are in there that shows me where I spent that at and where I'm going to spend that same amount of money the following year, right? But $50,000 is not a stab in the dark. I didn't throw a dart at a wall and say, I'm going to do 50,000 this year in advertisement. It's not, okay? I made a conscious effort on that, and that makes sense. Bank service charges would come on down the list, didn't make much difference. Charitable contributions. So this is, I have it as an expense, and it's not really an expense, right? Because we get to count this as a charitable contribution, so it'll come off the bottom line. But I like to have it up here. It's just a bonus. It's $9,500 that I can pull out of profit later on that we wouldn't be taxed on because it's a charitable contribution. But I like to plan for it for cash flow. So these are two charities that we will be participating in this year, and that's about what we're going to be donating. Commissions, I want to call attention to that. So traditionally, these are my commission rates paid over and above salaries. I'm increasing that this year, and there's a reason why. We lost a key employee that's growing another business of ours that had a lot of sales, but we didn't pay him commission, right? So now we got to pick up the slack and pay somebody else. The point of the story here, guys, I want you to be thinking about every one of these, and decisions you made in your business are going to impact that. So me sending an employee to go start another division somewhere that was selling for us here, and we weren't paying commission, we were just paying it in salary, means that if I got to replace that person with somebody we are going to pay commission to, I need a budget for what percentage of commission that might be. So this makes sense. It'd just be a slight increase in commissions. Credit card processing fees. This is one that when I had the meeting with my staff the other day, we identified as one we can probably make an additional savings on. Potentially we can start billing that back to the customer. That's a transaction fee. When we run a credit card for a sold job, that's a transaction fee of 3% or 4% if it's American Express that we pay on the job. That's $20,000. If we were to bill that back to the customer, that's $20,000 to go to the bottom line immediately. So the conversation come up with, if we start billing that to the customer, will we lose customers? Some people say, well, if I don't take credit cards, then they'll go elsewhere. Okay, maybe they will. But knowing what my net profit is, in this case, it's 13% I'm budgeting. There's a mathematical equation you can do to figure out how much work you can lose gross revenue wise and break even, right? So just to keep numbers simple, I'm going to say we make 10% net profit. If we make 10% net profit, and the argument is, Shawn, if you start charging the homeowner for the transaction fee, they're going to lose all those homeowners that would have paid you the credit card. How much work is that? Well, before I really lose, 10% of $200,000 is 20 grand, right? So I would have to lose $200,000 in work to break even to start charging everybody for the transaction fee. My average job is about $5,100. That means I would have to lose, if I do my math right, almost 40 jobs. 40 people have to walk out of here and say, I'm not doing business with you because you won't take a credit card. I don't believe that's going to happen. It might be 20. And if it's 20, then I come up net, I come ahead. Does that make sense? So this sheet tells me all sorts of information. Like I was able to make a good decision. We're now going to charge for 2020. We are going to charge credit card fees back to the consumer as a service fee. So then I can put a 0 in here. If I put a 0 in there, that changes the whole sheet. I want to show you guys. Now my budget for the year is $2,971,000. That's my total revenue that I need to make for the year. And that changed my monthly budget. I changed my monthly sales goal for my salesmen, changed my weekly production sales of installation for the crews, just by making that one decision, right? Change that.
So one sec, we got a question here. Axel which I think you answered. What about building in a 3% credit card cost on all jobs and offering a discount for non-credit card payment?
So that is going to give you the exact same answer at the end. I think it's more difficult to do that because when the homeowner sees the price at first, you're 3% higher than everybody else. And then you have to explain, oh, by the way, I'll give you a discount. But at first glance, you're already higher. And in our world, Mr. Fence, in our area, we are generally the highest priced fence company anyway. So our competition doesn't have the overhead that we have. None of my competition has a storefront and the trucks and everything that we have. So we come out the gate already 5 to 10% higher than our competition sometimes, generally. So if I were to do that, actually add that 3% on every job, now I'm just making that even worse, a bigger gap. So for me, it makes more sense to put it on the back end after I've already sold the job, after they get ready to process it. It's going to be more difficult for them to walk away from the table at that point. We already have a commitment. Yeah, they could walk away from the table, but it makes it a little bit more difficult. So yes, you can do it that way. I don't do it that way for those reasons. Hopefully that makes sense. Dump fees, we can't make trash just disappear, so it's not a big category we can make savings on. Education and training, I'm going to be cutting that this year. Last year we sent a lot of our employees to the AFA, Fence Tech, and then through the Fence School, and so that's where that cost came from. We're making a conscious effort on a little bit less people going this year because it's further away. It's in Salt Lake rather than it was right here in our backyard in Indy. I had to send everybody I possibly could and capitalize on that opportunity. So that's why that would lower down. Employee benefits really didn't make much changes there, but every one of the line items, we give gold stars, which are worth money to the employees. We pay for all their lunches. We have less guys utilizing the lunch system, so realistically, our lunch budget is going to go down. Let's just keep moving here. Insurance, we're trying to work on cutting our insurance down, but that's not something you can just flip a switch and lower. But if you notice, guys, every category, every line item by line item, I've spent hours going through the P&L, going through the cost and comparing it to previous years and understanding what am I doing this year that's different from last year. This office supplies is a big one. But inside office supplies, you've got my Dropbox account, Microsoft Office account, my company CAM account, my T-Sheets account. So these are all services that I pay for. They're apps of the company. Well, there's an additional one. We have True we're going to be using this year. So we're going to add that in. So I got to pay attention and make sure that's an accurate number. Probably taxes, you don't change much. Repairs and vehicle maintenance, big category, gets overlooked all the time. We've bought some newer trucks, or at least new trucks. So these numbers are going way down. We built some trucks last year. So in my vehicle repair is the cost associated to building some of these trucks out. You could have costed that as an asset. Again, the conversation would be, if I put it as an asset, it goes on my balance sheet, I depreciate it, I show more profit, I pay more taxes. So you just got to be careful where you put those expenses at. Can you expense it? If I can't expense it legally, I try to do that as much as possible. Then we got payroll overhead. So I'm right here where my cursor is. These are historical 2017, 18, 19, and then this year I'm budgeting for a $300,000 overhead. Payroll in the office. So that's me and the girls in the office, right in the office, and base salary for salesmen. So slightly reduction from last year, but not a major reduction by any means. And we're lowering our gross revenue by 10%, but we're not going to lower our payroll by 10% because we're not cutting everybody's pay. Let's see. Small tools is tools that we're buying. So we've literally tracked everything that is purchased per truck. When you replenish tools or have to replace tools or even just buy new tools to begin with. And these are small tools, that hammers and drills and things less than $500.
One thing, Shawn?
Yep.
Above, when you were covering your expenses, how often is that on point? Like how close are you able to get usually? It's
amazing. I blow myself away. Sometimes I get this stuff on an expense that might be $20,000, and in the year I'm off by $50. It's just a crazy how accurate it can be. Now there's times we may be completely wrong in a category, a truck blow up and have a $6,000 motor repair, didn't see that coming, and that'll just blow that whole budget out for that truck. That happens a lot. Or we may see a shiny new toy that we want to buy, or we may see a shiny new service. Let's try this, and that'll skew the numbers. I didn't know that going in. But you can adjust this budget if in March, when I'm at Fence Tech and I find something, we got to have that, I should come back and put it in the budget and see how it changes the end goal for the remaining rest of the year. Like, you shouldn't just do this one time and then not look at it to the end of the year. So if you need to make adjustments based on things that have happened in your company, you need to do that. If you're going to hire somebody, find out you need another person in the office, you better budget for that, put that in there. I like to use this when I think about buying a new vehicle, putting a salesman in the road, or hiring somebody else in the office to pick up the slack. I'll put that person in here in the sheet and see, what does that do? How does that change my gross revenue? How does it change my net profit? What does it make the business look like? Does it change the amount of I should be charging to a homeowner as a baseline price? So I'm 0.53 right now, I told you guys, but if I make some changes and buy some things and expense them, I may have to be at a 0.52 or 0.54, depending on where that number goes. And from that point on, I need to make sure that I'm using that number as a baseline check.
One quick question came in from Frank Horner. Do you supply all small hand tools for your crews?
Yes, so we don't use any subcontractors. And so we supply the trucks, all the small tools, good, bad, or indifferent. I fight a battle where they don't treat them well, they tear them up. It's a cost that I have built into this sheet. Could I save money and police that and tell them to use their own tools? Absolutely. But I've already got it expensed and built in here. So by me buying them and replacing them is not going to, I've already planned for that. If I really needed to cut numbers and save money, I could take that away and make them get their own. But then I got to fight that battle. Do they have the right tool? If I'm paying them by hour and that employee doesn't have the money to go buy an oscillating tool, which is the tool that's going to save them time over using a jigsaw and scratching up the post, then I'm losing. I'm paying them more labor because they can't afford to buy the tool. But if I provide all the tools, this is how I want it built. This is the tool you're going to use for this part of the process. And I expect a result being the labor to be X, the number of man hours to be X, because this is what it takes with this tool. I'm a big tool guy. I believe in tools. Obviously, Mr. Finn's tools we created because we create tools. But having the right tool for the job makes a huge difference in production. Right? It's not only the savings of labor, but you've got to put some value to, if I get the job done faster, can I not get the crew to the next job? And if I can do that, can I not increase my ability to do more gross revenue with the same assets? Right? So when you lose a day of production because a job rolled in the second day, and yet the crew can normally generate $5,000 worth of production in a day, that's $5,000 lost opportunity of income that you lost you'll never get back. No different than a rain day. If you're not building fence that day, it's lost opportunity. So all those things are used in the totality calculation of, is it valuable for me to buy those hand tools at $20,000 a year to replace them? I don't know. In my world, it's made sense so far. Hopefully that helps. Yeah.
Yeah. One more question came in from Ryan. Let's say you figure a job will take 4 days and you have your estimated cost of labor figured in for those 4 days. If your crew gets done in 3 days, do you ever give a bonus for getting the job done early?
So generally, no. And the reason is, do they ever give me money back when they take longer? So when the job takes 5 days, are they donating that 5th day to me? Yeah. They don't. And so to be fair, if I give them a bonus every time they beat that goal and I never take something from them when they don't, then just like this budget will go out the window because there's no give and take. There's no credits and debits. If it's all credits, you're going to lose. Now, do we give gold? So we have a gold star program. When somebody goes above and beyond their abilities, we give gold stars. Are those worth money? Yes. Is it worth a lot of money? No. If someone goes above and beyond or consistently is able to install fence faster as a whole, then they should be paid accordingly. And so they should be paid more per hour. At one time, I literally I paid everybody across the board a flat base hourly wage, minimum wage. Everybody in the installation side got paid minimum wage. And then we job cost every job anyways, but at the end of the job, we would job cost it. And if our labor was supposed to be 13%, we paid the difference between their minimum wage and 13% in a bonus every time. So if it got done faster, they got paid for the hours anyways. It was a win-win for the crew, and it was a win for us as a business because we knew our labor was consistent. The guys eventually fought us on it and did not want to do it anymore because of the credits and debits. They lost more than they gained. Yeah, sometimes they killed it. But overall, we were winning as a company because they got paid 13% whether it took them an extra day or not. And eventually their paychecks ended up being less than they were making as an hourly employee. And as a whole, they all came to us and said, oh my gosh, please stop this bonus program. When it was fair. What it proves to me is it's really more often than not, they don't hit the goals. And we don't really pay attention to that as much as they do when they go and install at a very fast rate. And we're like, oh my God, great job. So I think a small bonus, but not equal to the value that they saved in labor, if that makes sense.
Super. If we could, just one more question and then we'll get through the sheet. Oh, Ryan Gates says, great answer, thanks. Shauna Harrison is asking, Shawn, do you tell your crews how many hours you expect each job to take?
Yes. So that's communicated across the board. So my salesman has to think about the job in man hours, and they've got to bid that job that way, and it's put on the work order that way, and the crew's got to know in man hours. It's scheduled in man hours, and then we job cost it with man hours. So no different than we don't talk about fence lineal foot-wise. We talk about number of sections because that's the reality of the world we live in. We buy aluminum and vinyl in sections. We build wood fence in sections. So we talk about in sections. We talk about jobs in man hour rather than percentages. We use man hours.
Awesome.
Cranking along. We're almost at the bottom of the sheet. Let's see. Fuel. It's a big category. We track fuel per truck as much as we possibly can. We've had a problem tracking this in the past couple of years per truck. The vendor we were using, the reports we were getting was cumbersome, and it was something that I didn't put a lot of time and effort into to fix. We have fixed it this year. We have a new vendor, very super simple to track per truck. Every truck's got its own fuel card. So we're going to get more accurate data moving forward than we've had in the past few years. So a lot of this past data is garbage. The total expense for fuel is accurate, but per vehicle is garbage. You can see this vehicle fuel other down here where the girls were dumping it into a big bucket. I don't know which vehicle it went to. So it's not very accurate data per truck. I am making a huge cut in fuel, but we talked about that. It makes sense. We have less vehicles this year than we had last year. We used to have some benefits of take-home vehicles and things like that. We don't have those right now. So this budget number I think is very reasonable for us to hit. So that's my expenses. What does that mean? Those are controlled costs. I can go through and change any one of those items if I think I can make it an advantage, or I can go change them if I think I'm going to have an added expense. Keep that as accurate as possible. Down below here, this is my monthly cost for the month of January. Call your attention to that. That's the bill in the night. I'm going to pay $70,000 before I build the first fence. This company is going to cost me $70,000 to be open without even doing any work at all. So I've got to make enough profit to pay the first $70,000 to pay the cost of being in business, right? That equates to $3,189 a day. So I take the $70,000 divided by the 22, tells me I need to be generating, or I'm going to have a cost of $3,189 for every day that we're open, right? That we're in business. This number here is my total overhead that's generated by my goal, my revenue goal. So down below, you're going to see what my goal for revenue is, and it's going to be 8.7%. Let's go up here, 8.7% of my total revenue. That's going to be my goal for the month because that's what we did the previous year. What this tells me, guys, is I'm going to be a negative. Even if I hit my goal and we sell and install the goal, we're going to lose $7,600 in the month of January because I haven't sold enough work to overcome my overhead cost plus profit. Here's my amount of money I'm generating. Here's my cost. It's a negative of $7,600. And then I come down, I add this cash flow piece. These are assets that we're paying payments on, right? So they're not an expense, but I still got to pay attention to the cash flow. I'm a net $10,000 cash flow. And that's if I hit this monster goal of ours, right? So that's if. My goal, I'll come out a little further right here. installation goal, $155,000 is the goal, right? My average over the past 3 years is 159,000. That's data I have up here. But historically, I have 10 years where, look at this. In the last 9 years, I haven't even hit 155,000. So $155,000 is a big goal to hit for us in the month of January. Even if we hit it, we're going to lose 10 grand. So if I miss it by 10 grand, I'm 20 grand. This number gets real big real fast, right? So this is why we got to pay attention to costs, expenses. I've gone up above this sheet, and I've moved as many expenses as I possibly can for the month of January further down in the second quarter, everywhere I possibly can to try to minimize. So even doing that, I'm at $10,000 loss. I need to know that going in, right? Where am I going to recoup that money from? I got to have a plan. We need to know how that's going to come back. In the month of February, I've got a bigger goal. Come on down here. It's a percentage of the total revenue. It's 170,000. If I hit that 170,000, we're going to bring ourselves back to a positive. All right. We're going to bring ourselves back into a positive. We're going to make $2,800. Okay. If we hit that goal. What I'm learning is my break-even point in my business is somewhere around $165,000 of revenue. So $165,000 is what I'm going to have to do to pay the bill in the night, to pay the overhead, to break even, right? So anything less than that, I end up at a loss. Anything slightly over that, a slight gain. So January, February, March are showing a loss and small gains to where I have a net loss of about $3,000 in March. Now that was almost $40,000 when I started this budget process, and I had to move all kinds of stuff. If it wasn't for this budget sheet, I would have gone into this year and in March be almost $40,000 negative, pulling my hair out going, oh my God, freaking out. And in turn, selling decks, docks, pergolas, and railings, and selling everything I possibly can sell to get income in to make up the difference. So now we're chasing dollars we shouldn't be chasing. We're letting our business run us because we didn't plan. So by planning, I've done everything I can to set us up to pay attention to where we make the most amount of money. What are we good at? There's no fence company that's the best at commercial chain link and then installation of vinyl fence residential, and then you can do retail sales, and oh, by the way, we do gate operators. You can't be the best at all those categories. I like to think we are very good at all of them, but you need to figure out what you're really good at and what you make money at and focus on that. I see too many of us, me included, that have lost a lot of opportunity, a lot of money by chasing shiny pennies because we want to be known as the guys that do gate operators. Maybe we're not good at it. Maybe we shouldn't be doing it. Maybe we want to be known as the guy that does decks, but maybe we're not very good at it. Don't make very much money. So I have worked my tail off to get this number where it is at a negative $3,000 loss, and that's if everything goes perfect. Don't have a lot of bad weather. We don't have raising prices. We don't have anything catastrophic happen with equipment. So I've already had a meeting with my bank. Talked to them about the possibility of filling that gap in the first quarter. Now, the second quarter, we start making up ground real quick if we hit our goals, right? Start becoming very profitable per month. Generally, in a fence industry or a service industry, you hit your break-even point, you pay your overhead October, November when you start to hit your break-even point. And what that means is if my overhead expense is 34%, that's 34 cents on a dollar. And my net profit is at 13%. That's 13 cents on a dollar. When I pay that $1 million overhead that I have in here in budget, when I earn enough money to pay the overhead, now all the overhead money that I was making, 34 cents on a dollar, is net profit along with the 13%. So I'm making a 47 cents on every dollar I do. So when we get towards the tail end of the year, that November, December, or if your company can hit it in October, you want to put the pedal to the metal. Because now is when you get to make good money. Take every job you possibly can. At that time of the year, maybe even cut your costs because you can. You've already equated and you've already paid your overhead. So if I hit my gross revenue goal of $3 million by November, then everything in December is a 47% profit on every job we do. Then you can cut costs at that point, or you put the pedal to the metal and just start making some money. Let's see, this sheet in red, we come in through here and we update this every month. So we put our actual sales for revenue of installation and our actual sales of retail in there. And it gives us a sliding scale. Lets us know if we're ahead of schedule or behind schedule. And if we're behind, what do we got to do? We got to sell more jobs, which means what do we got to do? We got to have more leads. How do we get more leads? We got to look that back and say, what are we doing there? What expenses are going to cost us to get leads? But you got to start digesting backwards and stay on top of this. You don't want to wait another year and look and say, oh, we made it or we didn't. Somebody asked me the other day, how often do you look at this sheet, or how often do you pay attention to your budget numbers? I try to look at it every month, but I want to make sure that you take that with a grain of salt, because albeit I've costed these per month the best I possibly can, things are going to ebb and flow out of your control. And so some months, if you look at a snapshot of February, it might look really bad, and March look really good. You want to take the overall average. So the bigger the picture you take an average of, the more accurate that's going to be. Zooming into your business and looking at too small of a piece of it at one time is going to give you inaccurate information. The larger piece you can look at. So I budget off of last year's numbers and year total numbers as much as possible, rather than looking at every single month and giving it too much weight. I look at it, but I use it as a reference. I don't panic until you start to see a whole quarter losing money. Hopefully that makes sense.
Mm-hmm.
I want to make sure that I have time to show how we can use the percentage from this sheet to use as a baseline check on bidding projects. People ask all the time, what should I charge, or what can I charge for a fence? And my response is, well, that depends on your structure of your company. Your company structure is going to tell you what you need to be charging, and then you can play with that up and down. So if you can see the board, we're going to try this.
Can you, one thing, Shawn, would you be able to unshare so we can your screen so we can see you bigger?
Yep. Let me see here.
And how about it, guys and gals? You getting a lot of good value from this?
I hope so. Okay. You see the board all right?
Yeah, perfect. Thanks.
4 buckets: profit, overhead, labor, materials. Using that gross profit that I had in the sheet of 47%, which means cost of goods is a reciprocal of that of 53%, right? Baseline check. I have a job that I want to submit a bid on, and so I get a materials cost, and I figure it's going to take me a day's labor, right? So my materials cost for my supplier and a day's labor, both of these I know the cost of. I can figure out almost exactly what the cost is going to be of those two items, material and labor. That's cost of goods. That's, in my world, on my sheet, it's 53%. So materials and labor equals COG, cost of goods. That also equals revenue divided by percentage, right? Or I'm sorry, cost divided by percentage. So materials, let's say in this job, it's, keep it easy, $1,000. So fence is going to cost me $1,000, all my materials. And my labor for 3 guys in 1 day is going to be $450. So those are known costs, equals $1,450. So that, I know it's going to cost me $1,450 in direct cost to build that fence. I can take this number. I know that my budget sheet tells me baseline should be 53%. I should be 53% of my job total or gross revenue. So I can take 1,450 divided by 0.53. And that is going to give me the sales cost to the consumer, right? So I'm just going to take the calculator. 1,450 divided by 0.53 is $27.35. Now, I don't know how much per foot that is. I don't know how much per gate that is. I don't know how much per man hour that is. What I do know is that if I cost her here, I know that I got to pay for my overhead and my net profit. That's 47%. I know that if I take $27.35 and take the cost out, I'm going to equal the amount of 47% of this is going to be used for overhead and net profit. Now, this is a baseline check. So do I bid every job this way? No, I don't. But I use this as a reference and a baseline check. So if we have a job that typically, let's say it's a X type of fence, and we normally charge $21 a foot, right? I know I don't normally charge per foot, but a lot of guys do. So they normally charge $21 a foot. And that job equals, or total feet on that job is 125 feet, right? So then you would go to your calculator and say, well, Shawn, I normally charge $21 a foot times 125 feet. That's $26.25. So doing it your per foot method. What does that tell me? Is that my business is set up in such a structure that if I sell that job for $26.25, I'm leaving money on the table and I'm taking a loss and it's coming out of my net profit. Bottom line, it's coming out of my net profit. Out the gate, I'm losing money. If everything goes perfect, I'm losing money. Now, you may still want to sell that job at $26.25, and that's okay. But have a reason why. Is it a high profile spot? Is it on a corner that you're going to get your name recognition? Is it for somebody in need? Is it a super easy cookie cutter job that has little to no risk involved with it? Is it something you have in stock already and you don't have to put cash flow out to go get it? Is the job closer around the corner? Like, have that conversation and be like, okay, it makes sense. I want to do that. Or is it a hard job with a difficult customer a long ways away? If that's the case, I would probably want to be charging $28.25. Go above my baseline, right? I want to be paying attention to that. So do I check every job? No. But the bigger jobs, the ones that make bigger impact, I'm using a baseline check. If I don't have a budget and a forecast and I don't understand my business, then I will never have this information that is crucial to running a profitable business. I don't care what you sell. This method works for any widget that you sell. We're all in business to make money. The only way we make money is by using other people's money to buy products and services more conveniently or efficient than they can and provide them a service to make it worth their while and value. Every customer we work for could go build their own fence. They can learn and go through training and go buy vendors and buy the material themselves. But they're going to spend more time and more money doing that. What we bring to the table is a resource, experience, buying power to get their cost down. So we're using their money to make money. That's all we're doing. So I don't care what you sell. The principle is you're using someone else's money to make money. Pay attention to percentages. And the way you get percentages is by paying attention to numbers in your business. Does that make sense? Oh,
awesome. Frank Horner says, real good info. Thanks, Shawn. He did have another question. He says, I was wondering how you handle your salespeople, salary plus commission?
Yeah, we do salaries plus commission. I think is some value to motivating them to sell jobs. I do have somebody that gets paid a salary flat, and I've done all commission before. But traditionally, I go with the base salary and then a commission.
One more question, if we could. And I'm trying to keep us on time here. How much do you have more on your end, Shawn?
I'm okay right now.
Okay.
Good.
So let's do just a couple more. We have one more question here from Chris Steele, and then we'll do a final Q&A if people have other questions. Chris is asking, what process does your sales team have to price a project?
So what we do is we use a software system, CFS. So we're able to draw the project. What's important about that is it computes the material cost for us. So it counts all the tension bands and brace bands and posts and top rail and gives us a known cost. Again, if we know the cost of the materials and we can make an educated guess on the cost of labor, then we can figure out the total cost that we need to be charging the customer. So CFS gives us a cost of materials because we have our vendors in it. So when it gives us a material list, it's accurate. And then the salesmen are responsible for figuring out the number of man hours. You know, we have historical data that will tell you the number of sections of fence traditionally takes this number of man hours to build. We've even got it broke down to per section per man hour equation. So they're able to make a educated guess on how many man hours that project should take. Sometimes if it's a bigger project, we just look at the number of days and then multiply that by man hours per day. So a salesman says, I think it's a 1-day project, 8 hours, 3 men, 24 man hours. We know what our man hour cost is per hour. So known man hours, known labor, or known material cost will give us our total revenue. So we use a software system for it. I don't have cheat sheets with cost per lineal foot. We do have some cheat sheets that will give you a cost per section. We use as a reference for having a casual conversation with somebody when you're not giving them an exact quote.
Very cool. So I want to finish up here, we'll just share some couple remaining slides. I want to share how people can get in touch with you as well if they have questions. So let me go ahead here and just share this screen. So folks, if you would, I appreciate, and I know Shawn does too, everyone who attended this. Hopefully you learned a lot. We would love to hear your takeaways. What did you learn? What did you notice? What would you like to share? And I want to give a shout out to Tommy Ventura. Thanks for joining us. And Ryan Sloop said this was legit.
Thanks, Ryan.
So, yeah.
Well, I also want to challenge anyone else out there that watched this. Some of my peers that were watching this, I respect you guys in the industry. There's some really talented people in the industry for sure. Share your knowledge as well, right? I know it's challenging, it's scary. I was nervous to share this information by far, but there's people out there that have information, very valuable information that would help our industry. So I implore everyone here, if you have something of value, find a way to share it. If you're not a person that likes to speak about it in front of people, find a way to put it in writing. Find someone to help you share it. If we start sharing more information in the industry, we are going to help grow this industry where it needs to be. I've said over and over and over, we need to stop building fence like granddad and start building fence like our kids are going to need to build it in the future. But that also goes to running a fence business. We need to start running our fence business like professionals. And we're not going to figure that out on our own. We've got a bunch of us out rowing our own boats. I think we can get in the same boat and row together and help each other collectively as a whole.
Awesome. So a quick recap, we covered forecasting your budget, what to charge, the 4 buckets, leasing versus purchasing. You gave us a really awesome granular view of your budgeting strategy. And who here needs some help from Shawn? If you need some help, go ahead and post "Let's Talk" in the comments section, and he'll see that. And if you want to reach out him directly, you can reach him by email, Shawn@gomrfence.com, SHAWN @gomrfence.com. So let's see here, Shawn, if there's any further questions. Ryan says, great insight on some things that I need to look into and focus on. I appreciate it. And if there's any other questions. Any other questions, guys and gals? See here, let me go ahead and check over on Facebook just to see if there's anything on Facebook.
I can't believe we hit on time.
Yeah, right?
That's crazy.
Ken Throckton says, explain Gold Star program, what it is.
So
we do have some on Facebook. Let's start with Matt Worth, if we could. Oh, will this be available to rewatch? Yeah, Matt, we'll make sure you get a replay. Chris Meyer asks, I'm a one-man crew. What's the best way to price any fence? Not a lot of overhead.
So when that question come in? Because it may be in before I did the scenario on the wall.
2 minutes ago. Oh, wait. 4 minutes ago.
So to answer your question, you still need to price it the same way, whether you're a one-man show or not, whether your overhead's high or low. You need to look at your known costs, divide that by what your gross profit's going to be or plan to be. If you're planning on making 20% net profit, you're going to have some overhead for sure. You got to have insurance, fuel, truck, tools. There's overhead in there. So a lot of times you got to dig hard and think about what your overhead costs are. I challenge you to find all your overhead costs, put them into a sheet. Maybe one sheet, maybe easy to figure out, and then work backwards and use that baseline check. Awesome.
The chat is blowing up. I'm trying to keep up here. My goodness. So
oh my God.
Jared says, excellent webinar. The working on the business versus working in the business is currently one of my biggest challenges. Ken Throckmorton, could you please explain the STAR program, what it is, etc.?
So the Gold Star program, we use an app called Crew. It's free. We use it for communication through the company rather than group text. We use this app. Well, that app allows us to give gold stars legitimately. Like I could push and say, hey, gold star to the day, like grade schools type of stuff. You'd be amazed at what the recognition means to our team members when they get a gold star. So the gold star can be given from upper management, can be given from your peer, can be given from somebody below you. Anybody can give a gold star. What we did is we put a dollar value to a gold star. So they get $20 for a gold star and a bonus. And basically they get to expense $20 and give us a receipt, and we give them the money back for that expense. So we're able to cost it as an expense as much as possible. If they buy something that work boots or something related to the job, we can expense it. We don't hold them to that. They don't have to. So we give $20 for a gold star. Now those gold stars are given to people that go over and above their abilities. So that's the key thing, is that your all-stars don't get all the gold stars. Like they always do that. Okay, great. That's normal for you. So your baseline, you don't get a gold star. If you normally install that much fence every day and you did it again today, great. No participation trophy. But when the crew goes over and above what we expect them to do, then we give them or that crew a gold star. I also give gold stars every time that I have a customer to go out of their way to tell us how good that crew did. Absolutely, that's like a shoe in. If I have a customer come and tell me, call me, email me, come in the office and tell me how amazing your crew was, done. I will gladly give you guys the gold stars. That is very important to us.
That's awesome, because it doesn't always have to be financial. People just, want validation, recognition. Super. Rocky Morton asks, does gate fabrication go into overhead?
So gate fabrication for us is an overhead as far as the materials. I use them, shop supplies are in there. We don't cost them per job. If I can describe this. So we cost every job, materials to every job. But you notice, remember that 3% category I had up there earlier was job supplies. It was in cost of goods, but we don't actually cost every upright and every aluminum stiffener and hinge to each individual job. We look at it as 3% of the total revenue was used to purchase those items. Sometimes it's higher or lower, but average is 3%. So it's in cost of goods. So it's up top in cost of goods, not an expense. It's up there in that 53% cost of goods. The labor used to do it is up there as well. That's in that non-direct bucket. So there's that direct labor and that non-direct bucket. So my shop foreman's a non-direct guy. So it's in that. But when I look at my job costing per job, his labor is not in there because I'm not associating it to that particular job when he built that gate or pulled that product. We route all of our posts as well. And that, again, is a non-direct cost. I'm working towards a new software program that allow him to clock into every single job. When he routes the post or builds the gate, click a button, and it will associate that cost to the job. I challenge you to get every cost you possibly can costed to the job. I'm not able to get all of them there yet, close, but those pieces, building the gate is non-direct, and job supplies are in cost of goods.
Awesome. So we'll take one more question. I appreciate you going over here on this. We went a little over. Rachel Crow says, this was great. Thanks, Shawn. I work with companies across the country. When I talk to them about these same principles, you wouldn't believe how many companies have no idea what their overhead and profit is. Two more. We'll take two more here. Tommy Ventura asks, at what point should I look into hiring another salesperson?
So we had that conversation, Tommy, just with my company just recently. So we looked at the gross revenue number that we needed to generate. We could break that down to our average sale per job, right, of $5,100. And we can break that down to our capture ratio. We track the capture ratio. So we know that salesman A has a 50% capture ratio and salesman B has a 30% capture ratio. So then that'll tell you that if my average job is 5,000, I can divide that into 3 million. That tells me the total number of jobs. Last year we did 600. Now I know a total number of jobs. So if I need to sell that total number of jobs, I can back backwards and say, if I'm a 50% capture ratio, then I have the opportunity, I need the opportunity for twice as many, right, 50%, or 30% capture will be 3 times as many leads in order to sell that number of jobs. So you just keep working it backwards. And if you find that one salesman can't do, so we keep working it backwards, we find out that our average salesman can run 3 leads per day, 5 days a week, all year round, right? Effectively, then if we need more leads than that, you guys start looking, well, how's that possible? Can you run 4? Okay, well, you can't. Well, do we hire another salesman? Do we do it seasonal? Do we make a seasonal salesman, right? Do we start looking at that conversation? This year, we're looking at hiring another salesman because, obviously, with Josh leaving us, going to Florida, running the new location, and myself trying to work on the business and not in the business, there's a hole there. We figured out that we need 180 more leads this year if I pull out and don't do decks, docks, pergolas, and railing. 180 more leads, divide that per week, per day, start figuring out we need another salesman. So Tommy, I would challenge you to figure out how many leads can you do a day, what's your total revenue goal, what's your capture ratio on average been. That's going to tell you whether you can, whether you need to hire a salesman. Then you put that information into the sheet, and that'll tell you, can I afford this? Oh, I can't. I got to raise my revenue. Okay, raise my revenue. Now I need more leads. And you end up going back and forth, tit for tat, until you find a solution that fits that person, that salesman, and that those volume and that expense. It doesn't happen right away. You're going to spend hours going back and forth.
Awesome. We got Tommy says, great answer, thanks. Axel Boris says, great information. Shawn, 5 gold stars. And Chris Steele will be our final question here. And then folks, anything else, feel free to reach out to Shawn by email. I'll post the email again. But Chris,
well, I think Chris's question, how do you calculate cost of man hours? I'm assuming average. I use a lot of averages. Averages are very accurate the bigger the picture you take, right? So the bigger the picture, it takes up all the anomalies and inaccuracies and the highs and lows. So yes, an average is a great, what I use is an average rather than a direct per man hour. I don't take the 3 guys that have on the team, take their current hourly rate and add them up and use that, because you have taxes and things associated with labor costs as well. And you have highs and lows you got to absorb, as well as raises throughout the year. We're not trying to change this all the time. So to answer your question, I use an average hourly rate that I've figured up off historical data, past years, year, month, and use that number. Definitely use an average. I use average on almost everything because it's the most accurate piece. If you try to use the exact amount, it may be exact for what time, for that moment in time, but it's not going to be exact over a total large amount of time.
Excellent. Shawn, thank you so much. This was a wealth of information. And folks, I know it's going to take some time probably to digest all this. You're all going to get a replay as well. And I've posted Shawn's email in the chat. So Shawn at gomrfence.com. You can reach out to him directly with any questions. And any last words of wisdom, Shawn, you want to say to folks about budgeting or fencing in general?
I don't have fun with it. I enjoy doing this budget sheet. I didn't tell you this, but prior to 10 years ago when I used an Excel sheet, I didn't have Excel and computers. For years before that, I had notebooks. And I would literally write down, it's almost like playing a video game, but on paper. I would write down these budgets and these plans of attack. And I'd write down 2 or 3 different scenarios, and I'd be erasing and matching them and saying gross revenue with these percentages. And it just, don't be intimidated by it. This is why you're in business. Make up a business plan and put it in play and stand back and watch it and watch rewards of what you've created. Or fix it. Sometimes you make mistakes and then you have to stand back up, own up to it, and fix it. So my advice is have fun with it. Don't overstress it. Life is too short for that.
Awesome. Very cool. Well, folks, thank you for attending. Be sure to pat yourself on the back for taking action on your budget. And with that, I suppose we can come to a close.
All right. Thank you.
All right. Thank you so much, Shawn. Thank you, everybody. Have a great rest of your day. Bye.